I'm Miles Kripendorf, and this is my personal finance project on my book I chose, Little Book of Common Sense Investing by John C. Bogle. To start this right off, we'll go right into Chapter 1. Chapter 1, A Parable, talks about the Gottschalks family, a story by Warren Buffett. The Gottschalks family invests in lots of investments, and they want to increase their earnings. So they go to fund managers, to help them. But in the end, they lose money. This is because they likely chose a non-fiduciary. A non-fiduciary tries to make money off of you and to make profit for their company, taking fees for themselves. Fiduciary works only towards your benefit. They're not trying to scam you or make money off you, but to use your money to make more of it. I included Chapter 12, Seeking Advice to Select Funds, on this slide, as it talks of the same topics. Chapter 2, Rational Exuberance. Speculative investing is buying assets using past performance in hopes of better outcomes. In the graph, you can see that the investment's earning goes above and below the market return. The past does not portray how it will constantly do in the future, and there are always bumps along the way. Price to earning ratios is the price of the stock versus the earnings it made. Basically, how much an investor is willing to spend on it based on speculation and performance. The price and earnings ratio goes up and down based on past performance due to what investors speculate. So that's how it affects the performance. Chapter 3, Cast Your Lot with Business, is all about the S&P 500 Index Fund. The S&P 500 Index Fund is a collection of stocks that follow along with the total market, but compile many different stocks to get a higher value. These stocks make up for each other when one goes under, and they have different weightings in the actual fund based on how well and how big a stock is. As you can see on the right graph, the S&P 500 closely follows the total market index correlation, as they share a lot of the same funds. You can see on the left. Chapter 4, How Investors Turn a Winner's Game into a Loser's Game. As you can see on the graph to the left, the assumed market return with 7% before cost is almost $300,000. The assumed fund return, which is 5%, after only 2% cost, is $114,700, only half of the $294,600. That's $179,900 loss in compounding costs over the years. That 2% builds up over time and takes up so much of your money. That's why it's so important to pick the right funds that have very low fees to get the most of your money over time. As I said last slide, funds eat up your profits a lot. So which fund should we choose? Low-cost index funds versus high-cost index funds. The low-cost fund has lower expense ratios and is the best option to minimize fees. A high-cost fund has a higher expense ratio and based on fund provider potential higher value added. When investing in long-term, which you should be, a lower cost is the best option as the fees are the lowest and will give you most of your money back. Chapter 6, Dividends are the investor's best friend. Dividends are a portion of a company's profits that are distributed to investors over set times, usually quarterly. As you can see on the left, the dividends per share are pretty high nowadays, up to $45.70 by 2016 for $100 invested. On the right, you can see the S&P price return versus total return with dividends reinvested. The solid line shows investors reinvesting with the dividends they earned, making almost $58 million more than the S&P price appreciation only. These dividends can add up over time and be a huge benefit to your profits. Chapter 7, The Grand Illusion. Returns reported by mutual funds are not what the investors get most of the time. Active funds may promise to use professionals to sell and buy at the right times, but these services cost money. As you can see on the bar graph on the right, the average fund makes almost $170,000, but you only get about $100,000 before taxes and $80,000 to Wall Street due to the high fees it incurs. On the left, you can see an index fund with $170,000 going towards you and only $8,400 going to Vanguard. That's because of the lower cost the index fund has as it is passively run and doesn't need all those professionals to sell and buy at the right times. Chapter 8, Taxes Are Costs Too. In this chapter, John C. Bogle stresses the importance of taxes and how you should be making sure your investments are tax efficient. Taxes can take out a super large portion of your earnings that you don't even notice. Here are some ways taxes affect you. In exchange traded funds, investors buy and sell shares on an exchange, and so the taxes are mitigated through the stock exchange. They're not buying it straight from the fund. And mutual funds, buyers and sellers are going straight through the mutual fund, and they have tax implications implicated on them. Chapter 9, when the good times no longer roll. Stock funds are always on a steady trend. They can rise and lower based on performance in the market. Here on the chart on the right, you can see the investment return and the speculative return. They differ due to how investors see the past and how they think the future is going to go. The important lesson is to keep your money in over time, because as you can see the graph, it's all going up. They are taking losses, but it's still going up in the end. So it's important to keep your money in to get the most amount of money earned at the end. Chapter 10, Selecting Long-Term Winners, talks about how hard it is to find a single good performing fund. There's almost 80% failure rate, and so a better strategy would be buying a portion of lots of funds, so that the ones that go under are covered by the ones that do great. Chapter 11, Reversion to the Mean. A mean is a steady path that's the average earnings of a fund. Usually, when a fund goes up or goes down, it will always return to its average funds after time. Just because of a small spike or drop, you should not put in or take out your money. Reverting to the mean is almost guaranteed, and you will see the benefits in the long run. As you can see, a mean is not flat, it goes up. So even though it looks like you're losing money, it will always go back, and you will make money in the end. Chapter 13, Profit from the Majesty of Simplicity and Parsimony. Bogle suggests that a simple path is always the best path. Going out of the way and trying to get extra earnings may lead to a worse outcome in the end. On the left, you can see an actively managed portfolio. Its percentages outperforming a passive index fund over 50 years take a staggering drop to 2%. Going simple with a passive index fund is a more sound option than an active fund, and the benefits you can see are lower costs, less risk, and high long-term profit. Chapter 14, Bond Funds. A bond fund is a type of investment fund that pools money from many investors to buy a diversified portfolio of bonds or debt securities issued by governments or corporations to raise capital. They are usually a much less riskier option than stock investments. Basically, you're giving your money to a company, and they're telling you that they will pay you back after a certain amount of time. The return is guaranteed, which is a very good quality of the bonds, and they're much less riskier than a stock. Chapter 15, the Exchange Traded Fund. An ETF is a type of investment fund that holds assets such as stocks or bonds. It pools together investors' money to invest in a diversified portfolio, but unlike mutual funds, they trade on the stock exchanges, meaning investors can buy and sell them throughout the trading day at market prices. On the left, you can see that there's not a ton of factors that make them better than your standard index funds, but the main pull is the trading factor, meaning that active and smart investors could possibly make money on their ETFs by buying and selling them for a higher price than they were bought. Chapter 16, Index Funds that promise to beat the market. Bogle emphasizes that no fund can totally beat the market constantly. That the funds that do claim to beat the market may be only telling a partial truth. All funds move up and down, so it won't be beating it for a while. And even if it is, you're likely paying various fees, as in trading taxes and fees for the actively managed funds. You shouldn't be trying to beat the market anyways. You should be trying to go along with it, because if you are in the long game, going along with the market will generate you plenty of money in years to come. Chapter 17, What would Benjamin Graham have thought about indexing? Now, who is Benjamin Graham? He's considered the father of value investing, and he emphasized the importance of thorough analysis and stock selection in his investment philosophy. He advocated for a bottom-up approach to investing, focusing on individual companies rather than broader market trends. He's acknowledged the difficulty of consistently beating the market, though, and recognized the value of diversification. What would he think about the index fund? First, he might be skeptical, as he preferred individual companies, as I said earlier, although after they gained some popularity, he may have liked them as they demonstrate his values of low cost and diversification. Chapters 18 and 19, Asset Allocation Part 1 and 2. Asset allocation is moving your funds to different investments so if one goes down, all your money isn't lost. And in Exhibit 18.1, you can see how different high-cost active managed funds and low-cost index funds divert your funds. In the active managed fund, you can see the stock percentage is higher than the bonds percentage. You can see that the gross return is a lot higher, but the costs are also high, resulting in a net return of 3.5 to almost 2% lower than the gross return. The low-cost index funds, the stocks percentage is 25% and bonds is 75%. You have a lower gross return of 3.75, but your costs are 0.09, next to nothing. So your net return is actually 3.66, higher than the net return of the actively managed funds. While bonds don't make a ton, it makes up for it in its risk. There's next to no risk for bonds, while stocks may make more money, but they have a higher risk. The last chapter, Chapter 20, Investment Advice That Meets the Test of Time, is a list of advice Bogle offers the readers. They're very similar to what we've learned in class, and here's some important points I gathered from the chapter. Beating the market is a waste of time, but following the market along is a sound strategy. Another one, actively managed funds always have fees higher than passively managed funds. Do your research to figure out the best options and beware of the impact of even small fees. Mr. Przowski showed us how small fees can impact your investment heavily in the end. Your investing should always be long-term. It is almost impossible to be beating the market and be getting that money. If you're investing long-term, you don't need to worry about that as your money grows with it over time. And lastly, simple is key. Putting your money into a trusted fund for a long time is much more advantageous than some active funds that claim to be great, only to be met with high fees. Overall, Bogle says that long-term investments in passive index funds are the best options for retirement planners.